Hi, I am OG John AGR, and what I am about to walk you through right now is not a theory, it is not a prediction, it is not something I read on Reddit at 2 in the morning. What happened yesterday on Wednesday, February 25th, 2026 is documented, time-stamped, and sitting in plain sight for anyone willing to look. 48 hours before March 1st Notice Day, the single most important delivery deadline in the silver market this year, CME Group halted all metals and natural gas futures trading on its Globex platform. Completely. No warning, no timeline for resumption, just a status page that read, investigating. And while the lights went dark on the paper market, Shanghai silver was trading at $102 an ounce, a 16% premium over a Western market that had just been switched off. You want to understand what is happening in silver right now? This is it. This is the moment everything we have been tracking, the drainage, the delivery rates, the inventory numbers, the positioning data, comes together. Tomorrow is First Notice Day. And the world's most important commodities exchange just pulled the plug 48 hours before the most critical delivery window in years. Let's get into every number, every fact, and every implication, because this is the most important silver story of 2026, and almost nobody is connecting the dots correctly. Let me give you the raw sequence of events, because the timeline here is everything. On Wednesday, February 25th, 2026, at 12:11 Central Time, CME's Global Command Center acknowledged a technical issue. By 12:15 Central Time, the exchange confirmed a full halt. Natural gas quietly resumed at 12:50 Central Time. Metals, the category carrying all the delivery pressure, all the short positions, all the open interest, stayed dark. No timeline. All-day orders and good-till-date orders placed for Wednesday were canceled. Good-till-canceled orders with prior confirmations survived. That was the totality of the explanation. Technical issues. That's it. Now here's what you need to understand about the timing. March 1st Notice Day is February 27th. That is tomorrow, as I record this. First Notice Day is the date when any trader holding a long silver futures contract can formally notify the exchange that they intend to take physical delivery. Not roll their contract forward, not cash settle, take the actual silver. Tomorrow is the line. And the exchange that runs the paper silver market decided to go dark 48 hours before that line. Think about who that benefits. It is not the people demanding physical metal. It is not the industrial buyers who need silver for solar panels and AI data centers and defense systems. It is not the people whose delivery notices were queued up and ready to submit. A halt 48 hours before First Notice Day benefits exactly one category of market participant: the ones who needed time, the ones who needed breathing room, the ones who were, as of Wednesday morning, staring at a number that keeps getting worse for them every single day: 88 million ounces. That is how much registered silver COMEX has. 88,191,059 ounces, to be exact, as of the most recent data. Registered silver is the only category that matters for delivery. It is the silver that carries a warrant, that is physically pledged, that can actually be handed over when a futures contract holder says, "I want my metal, 88 million ounces," and on the other side of that number, the paper. Total open interest on silver futures contracts representing, depending on which source you use, somewhere between 400 million and 529 million ounces of theoretical delivery obligation. Let me put that ratio into language that requires no financial background to understand. For every 1 ounce of silver that is actually sitting in a COMEX vault and available for delivery, there are between 4.5 and 6 paper claims on that same ounce. And tomorrow, the people holding those paper claims can start filing for the real thing. That is what was supposed to happen until the exchange went dark. This is not the first time CME has had a convenient failure at a pressure point. On November 27th and 28th, 2025, CME Group suffered a catastrophic 10-hour outage that froze trillions of dollars in derivatives globally. The official explanation at the time was a cooling system failure at a data center in Aurora, Illinois. CyrusOne, the company that runs the facility, later admitted the outage was caused by human error. Staff failed to follow standard procedures for draining cooling towers ahead of freezing temperatures. CME had a backup data center in New York. They chose not to activate it because they thought the outage would be brief. It lasted over 10 hours. Yesterday's halt on February 25th, 2026 is the second time in less than 3 months that CME's infrastructure has failed at exactly the moment when silver delivery pressure is highest. The November halt happened as delivery demand was accelerating. Yesterday's halt happened 48 hours before the delivery trigger. You can believe this is coincidence. You can believe every cooling system in America decides to malfunction precisely when silver open interest is at catastrophic ratios against physical inventory. You can believe that. But you should at least acknowledge what the data shows. And the data shows a pattern. While the paper market sat frozen yesterday morning, on the other side of the world, the physical market was screaming. Shanghai silver, trading on the Shanghai Futures Exchange, which had just reopened from the Lunar New Year holiday, hit $102 per troy ounce. Western spot was around $90.96. That is a 16% premium. Shanghai silver was trading at $102, while New York silver was shut down at roughly $91. In China, the world's largest physical silver consumer, the metal costs 16% more than the paper price in a market that literally could not operate. The Shanghai Futures Exchange has already restricted 23 accounts in February alone for exceeding intraday position limits. Regulators in China are watching this so closely that they are intervening in real time to prevent a disorderly squeeze. Shanghai warehouse silver inventories have collapsed to just 318 tons. For context, that is near the lowest level in a decade. And yet, despite these constraints, despite the restrictions, despite the inventory lows, the premium held at 16%. That is not a market where supply is catching up. That is a market where the physical bid is so strong that even regulatory intervention cannot compress it. Let me give you the full picture of how we got here, because the numbers only make sense with the history. At the start of October 2025, COMEX registered silver inventory stood at approximately 346 million ounces. That was already a number that should have concerned anyone paying attention. Then the withdrawal began. October, November, December, January, February. Every single month, metal leaving the vaults faster than it comes in. By the time we crossed into February 2026, we were below 100 million ounces. Last week, we crossed below 90 million ounces. Yesterday's number, 88.19 million ounces, from 346 million to 88 million in approximately 5 months. That is a 75% drawdown in registered, deliverable silver at the world's primary futures exchange. That drawdown is running at roughly 20 million ounces per month. Do the math on what that trajectory looks like by the April delivery window, if nothing changes. And here is what makes the math so brutal right now. The people who are responsible for the delivery process, the banks and dealers who actually move physical metal, they are already at their limits. Silver lease rates, which measure what it costs to borrow physical metal for short-term settlement, hit 34.9% annualized in recent weeks, with intraday spikes to 39%. Normal silver lease rates are 0.3% to 0.5%. When lease rates go from 0.5% to 35%, that is not a market signal. That is a market screaming. It means the people who need to borrow physical silver to cover their delivery obligations cannot find it. And the people who have it are demanding extraordinary compensation to part with it even temporarily. At 39% annualized lease rates, borrowing silver for 30 days costs over 3% of the value. In a normal market, that is essentially free. This is not a normal market. Now let's talk about what February deliveries told us about what March is about to look like. The delivery rate for February silver contracts ran at 98%. 98%. In a normal delivery month, 1% to 3% of contracts stand for physical delivery. The rest roll forward, cash settle, or close out. 98% is not a rounding error. 98% is the market telling you, in the clearest language possible, that the participants holding these contracts do not trust the paper system anymore. They want the metal. They want it in their vault, in their possession, away from the CME ecosystem. February saw delivery demand that would have been statistically impossible by any historical standard. Every major historical comparison is obsolete. We are in territory that has no analog in the modern futures market. And now March is next. If even half the participants who held February contracts through delivery follow the same pattern in March, if the delivery rate in March comes in at 50% instead of 98%, you are looking at demands that dwarf the available registered inventory by a factor of 2 or 3. If March runs anywhere near the February pattern, the arithmetic does not work. There is not enough registered silver to satisfy the delivery demand, and tomorrow is when the clock starts. Here is where the macro context matters, because silver does not move in isolation. Yesterday, silver cracked through $90 for the first time in 3 weeks, not drifted through. Cracked through with a morning high of $91.18 and a closing area around $90.68, up nearly 4% on the day. Gold was at 5,200 at the same time. the gold-to-silver ratio compressed to 57-1, down from 64-1 earlier in the month. That ratio compression is itself a signal. When gold and silver both move higher but silver moves faster, that is the physical market asserting itself. Industrial buyers cannot substitute gold for silver. The circuit boards, the solar panels, the EV charging systems, the AI data centers, they need silver. Not gold, not copper, silver. And those buyers are not waiting for the chart to look pretty. They are filing for delivery or paying the physical premium because they need to keep their production lines running. The macro environment feeding this is equally extraordinary. On Friday, February 21st, the United States Supreme Court struck down President Trump's sweeping tariffs. The ruling created immediate uncertainty across global trade policy. Then Trump, standing in front of the Supreme Court justices at Tuesday night's State of the Union, called the ruling very unfortunate and vowed to reimpose tariffs under a different legal statute, Section 122. He has now imposed a 15% global tariff to replace what the court invalidated. Trade policy is in a state of chaos. The dollar does not know where to go. Real yields are falling. And in that environment, gold and silver do what they always do when the paper system shows its cracks. They go up. JP Morgan's own head of macro strategy for Asia, Yuxuan Tang, said this week, and these are his words, not mine, a breakout to the upside is in the making, citing tariffs and Iran tensions as two factors that may catalyze a more sustained shift. When JP Morgan's own senior strategist is calling for an upside breakout in silver and gold, while JP Morgan simultaneously holds significant short positions in COMEX silver that have been documented in multiple reports, you start to understand the nature of what is happening. The left hand is telling retail investors to buy. The right hand is managing a paper short book under extraordinary pressure, and the world's largest commodities exchange just halted trading 48 hours before the moment when that pressure reaches its legal apex. Let me talk about Iran, because this is a real wild card on top of an already explosive setup. Trump this week confirmed that the U.S. is in negotiations with Iran. At the same time, he threatened that the U.S. would never allow Iran to have a nuclear weapon, and made it clear that military options remain on the table. Precious metals have a direct sensitivity to Iran tensions because Iran sits on critical energy and mineral supply chains, because Middle East tensions elevate safe haven demand globally, and because any military escalation pulls capital away from equities and into physical stores of value. Silver moves faster than gold in that environment because it is the smaller, more volatile market. When $100 million of institutional safe haven capital hits gold, it barely moves the needle. When that same $100 million hits silver, it creates a genuine price shock. Right now you have Iran tensions, Trump tariff chaos, Supreme Court constitutional drama, and a COMEX that shut down during the most sensitive 48-hour window of the year. Every one of those factors points in the same direction for silver. Now let me tell you what Bank of America said, because this deserves to be on your screen in full. Michael Widmer, Bank of America's head of metals research, has projected that silver could reach between $135 and $309 per ounce. Not a fringe analyst, not a silver permabull on YouTube. The head of metals research at one of the largest banks on earth. $135 is the conservative end. $309 is the scenario where the gold to silver ratio normalizes toward historical norms against a backdrop of sustained gold strength. Gold hit $5,600 as its all-time high last month. If gold stays in the $5,000 to $5,600 range, and the gold to silver ratio compresses from current levels toward 20-1, which is where it has historically been during peak precious metal cycles, the math on silver is violent. At a 20-1 ratio and $5,200 gold, silver is $260 per ounce. At $5,600 gold, silver is $280 per ounce. Bank of America is not making that prediction because they are crazy. They are making it because the structural deficit, the sixth consecutive year of supply shortfall, the 67 million ounce gap between supply and demand in 2026 alone, and the industrial demand trajectory from solar, EVs, AI data centers, and defense applications do not point toward $90 silver being a ceiling. They point toward $90 silver being a pit stop. And the COMEX inventory situation means that whatever price discovery is coming, it is not coming from a well-supplied, orderly, efficiently functioning paper market. It is coming from a drained vault, a halted exchange, and a Shanghai market paying a 16% premium to get physical metal in its hands. Let me now walk you through exactly what to watch tomorrow and in the days that follow, because the next 72 hours are going to define the direction of silver for the next 30 to 90 days. Tomorrow, February 27th, is First Notice Day. That is when long contract holders file delivery notices. The exchange then has the delivery period, which runs through the end of March, to fulfill those obligations. Here's the question that matters. How many of the March open interest contracts stand for delivery? If 5% stand for delivery, that is roughly 26 million ounces demanded against 88 million registered. COMEX delivers. Market breathes. Shorts survive. If 25% stand for delivery, that is 132 million ounces demanded against 88 million ounces available. The math breaks. If 50% stand for delivery following the February pattern of 98%, we are looking at demands between 264 and 529 million ounces against 88 million available. The system does not have a mechanism to resolve that outcome without either emergency inventory transfers, mass cash settlement, or price discovery that forces contract holders to give up delivery voluntarily because the price has risen enough to make it economically rational to sell back. Any of those outcomes is explosive for price. Cash settlement with penalties signals that COMEX cannot deliver, which sends institutional money rushing to secure physical supply at any price. Emergency inventory transfers from eligible to registered categories would extend the runway but cannot fix the fundamental mismatch. Price-induced capitulation of delivery demands would require silver to move significantly higher to create enough paper profit for longs to choose to sell back rather than take delivery. All three paths lead to higher silver. The only path to lower silver in the short term is if March delivery demand completely collapses. If the participants who held contracts at 98% delivery rates in February suddenly, on first notice day tomorrow, decide en masse to roll everything to May or cash out, that would require a catastrophic breakdown in conviction by the same buyers who were paying 27% to 120% premiums for physical silver eagles. That would require the same industrial users who are currently competing for 88 million ounces of registered COMEX inventory to say, actually, we do not need the metal right now. That scenario is the one that requires suspension of everything the data has been showing for the last 4 months, and it is the one scenario the exchange would prefer. Watch the delivery notice numbers the moment they start flowing after market open tomorrow morning. Watch COMEX registered inventory updates, which publish nightly at 9:30 p.m. Eastern on the CME website. Watch the Shanghai Premium. If it expands above 20% when Chinese markets open, that is the physical bid strengthening. If it contracts toward 10% or below, that is some supply relief coming in. Watch lease rates. If they spike above 40%, the physical squeeze is intensifying. If they compress toward 10%, it is easing. Watch the gold to silver ratio. A move below 55-1 means silver is outperforming gold on institutional buying. A move back above 60-1 means silver is losing momentum relative to safe haven flows. And watch the first 2 hours of trading tomorrow morning when the market reopens after yesterday's halt. The first 30 minutes of trading on first notice day will tell you more about March delivery pressure than any analyst prediction you will ever read. If silver gaps up above $92 to $93 on the open and holds, institutions are front-running the delivery squeeze. If it gaps down below $88, something has changed in the short covering calculus overnight. Either scenario is information, but you need to be watching when it happens, not reading about it 4 hours later. Let me tell you what the two camps of people watching this right now are experiencing. The long-term physical holders, and that is most of the people who have been following this channel for months and years. You understand that yesterday's CME halt does not change anything about why you hold silver. The structural deficit is the same. The 6th consecutive year of supply shortfall is the same. The 67 million ounce gap between what the world produces and what the world needs is the same. China's export restrictions on refined silver, implemented January 1, 2026, are the same. The industrial demand from solar, EVs, AI infrastructure, and defense is the same. The fact that COMEX registered inventory just hit 88 million ounces, its lowest level in modern market history, is not changed by a halt. If anything, it is confirmed by the halt, because systems that have adequate supply do not need emergency pauses 2 days before delivery. If you are a stacker, you know what this means. You are watching the paper system under maximum stress decide whether to break or bend. And you have positioned yourself so that whatever happens in the paper market, your physical metal is in your hands, not in a COMEX vault that just went dark. For the short-term traders and futures participants, this environment is genuinely dangerous in both directions. A halt followed by a gap open on first notice day could produce intraday moves of 5% to 10% with no warning. Margin requirements are already elevated. The CME has shown it is willing to raise margins again without notice, as it did on January 30th, which triggered the worst single-day silver crash in recorded history. If you are holding leverage positions overnight going into tomorrow's open, you need to understand that you are accepting volatility risk that cannot be fully priced or hedged in this environment. Either reduce your size significantly or make sure your stops are wide enough to survive a gap move in either direction. Here is the unresolved tension that I want to leave you with, because this is the question that matters right now. The CME halted metals trading on February 25, 2026, 48 hours before the most critical delivery day in the silver market this year. Was it a genuine technical failure? Was it something else? Nobody outside the exchange knows the answer to that question, but here is what we do know. The halt happened. The timing is what it is. The registered inventory is 88 million ounces. The paper claims are between 400 and 529 million ounces. Shanghai is at $102 when Western Spot is at $91. Lease rates have been at 39%. February deliveries ran at 98%. Bank of America is projecting $135 to $309. JP Morgan's own strategist is calling for an upside breakout. The sixth consecutive supply deficit is locked in for 2026. And tomorrow, for the first time this year, the people holding long silver futures contracts can walk up to the delivery window and say, "I want my metal." We are about to find out what happens when the paper system runs out of runway on the same day the physical market has already run out of patience. Do your own due diligence, make your own decisions. If you are leveraged, reduce. If you hold physical, watch and wait. If you are on the sidelines, understand that whatever tomorrow brings, it is not the end of this story. It is the beginning of the chapter where paper price and physical reality are forced to reconcile. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. I'll be back tomorrow with every delivery number as it drops. March 1st notice day is here. OG out.